Hi, this is Brett Cohen, and I'll be presenting Disney for my final stock pitch. Right off the top, I propose that Disney is an extremely strong buy. I achieve a price target of $206.13, which is a potential upside of 39.6%. This is due to a mix of my quantitative analysis as well as some qualitative factors, which include talented leadership, strong market conditions, high barriers to entry, a strong brand, competitive advantage, changing entertainment landscape, and a diversity of revenue streams. And with this in mind, I reiterate Disney is a strong buy. So, some company background. Disney is a multinational mass media and entertainment conglomerate that was founded in 1923 and is headquartered in Burbank, California. They have five major divisions, which are the Walt Disney Studios, Disney Media Networks, Disney Parks, Disney Experiences and Products, and Disney Direct to Consumer and International. Some subsidiaries that are not as well known to be owned by Disney but are indeed very popular include ESPN, ABC, National Geographic, Hulu, and their 14 theme parks around the world. And their CEO is Bob Iger as of 2005. So the first factor is strong leadership as well as proper incentive structure. So their executive team is extremely talented with long tenures at Disney, who have been at the firm for a significant portion of their careers. And compared to many competitors, Disney has a relatively high rate of inside ownership, so their executives have skin in the game and are directly invested in seeing the company do well and seeing the stock price appreciate. This is just a breakdown of the Disney media empire. As we can see, the biggest cash cows are Disney Media Networks and their parks and resorts. Another factor I'd like to hit on is favorable market conditions. So there's a growing world economy with strong consumer spending, with an increase of such of 2.9% in the third quarter of 2019. Relatively high consumer confidence. So while the trend is toward going on a downturn, we still are at that level above 100, which is critical. On top of that, despite trade tensions, the Disney business model does not rely as heavily on Chinese manufactured goods as others. So the next factor is barriers to entry. So they have a diversity of business units that gives them exposure to various sectors, and their most lucrative are entertainment and content production slash distribution. Most specifically, these sectors have extremely large capital requirements to be entering to the industry, and there's also a very high cost of brand development, both financially and from a time perspective. So, customers are taking some time in developing affinities for the Disney brand, and that's not something that can just have money thrown at it and the same result be achieved. They have nearly a century of brand development under their belt, which includes strong family brands like Disney Princesses, Pixar, Star Wars, Marvel, etc., with many years of fandom and culture built around them, as well as assets like National Geographic, Disney and Hulu, Disney Plus and Hulu, which will give them huge opportunities for more content creation and further brand development. As far as theme parks go, theirs are widely regarded as the cream of the crop, which is an extremely hard status to achieve and one that is pretty invaluable as far as the value of their brand goes. Competitive advantages include huge amounts of intellectual property that can be monetized through their various subsidiaries. So their business model helps to reinforce the value of their intellectual property, which is extremely lucrative. They also have extremely strong content creation teams that can produce new intellectual property and have been quite successful in the past, as we've seen. And their primary strategy for competitive advantage is that of product differentiation, which entails bringing unique offerings to a wide audience through innovation, delivering quality and uniqueness through innovation. The next factor I'm going to hit on is the changing entertainment landscape, especially as it relates to streaming, being that Disney Plus is one of their newest platforms and hopefully successful revenue streams. I'd like to focus on that most specifically. So, based on my research, I've deduced that 64% of homes with Wi-Fi use streaming services, which is up 17% year on year, and 28% year-on-year growth in time spent streaming. Amongst 18 to 49-year-olds, 27% are not any longer subscribed to a traditional cable service, which is a figure up 50% year on year, and 47% are light TV viewers. So this reinforces the trend of cord cutting, as we've heard of. Disney assets have 59% of the U.S. streaming reach, so that includes Hulu, Watch ESPN, and ABC. And early investments in this trend through various platforms such as ESPN, Hulu, and Disney Plus will ensure that Disney's well equipped for this change, and it will continue. They'll continue to be well equipped for this in the future as this trend goes even further. According to digital TV research, Disney Plus will reach 82 million subscribers by 2024, which is an absolutely immense amount of people and is a lot of potential revenue to be brought in. Their variety and diversified revenue streams give them a more stable business model than their competitors, which could be seen as a hedge against sector-specific underperformance, and their international exposure protects them from country-specific economic woes. To end our qualitative factors, I'll give some industry projections and trends. So the experience economy has led theme park spending to grow 5% in 2018 to $44.8 billion, and this has been said to be fueled largely by social media, and this trend is only expected to continue according to Forbes. They describe this as a trend that shows growing preference for consumer spending on experiences rather than products. And digital TV research says that the 5 major video on demand platforms will have around 529 million subscribers by 2025. And based on the figures we've seen in previous slides on Disney's share of the streaming services, this is a pretty huge piece of an enormous pie to be had. Now comes our quantitative analysis. So in formulating my WACC, there were a few assumptions that I made. Most specifically, when it came to beta and formulating my cost of equity, I chose a 5-year beta to capture the effect of economic variability. On top of that, there are new business ventures like Disney Plus and other things that are included in their high growth strategy, which is fueled by acquisitions, might bring higher volatility in their stock price. So with all of this baked in, my WACC figure is 7.11%. For my DCF, there were various assumptions I made as well. So my tax rate was just the average of my 5-year projections. I figured this was the most logical way to go about it. I chose a terminal growth rate of 4%, which some might argue to be a little bit high, but I wanted to place it ahead of USA GDP growth, which is around 2% because of their strong international exposure. Their 2019 and 2020 revenue streams or the revenue growth was extremely high because of the inflow that I anticipate of recurring customers coming from the introduction of Disney Plus. This slows down after about 2 years, plateauing at about 6.5%, which is still ahead of competitors. And I did this because of their diversified revenue stream. So here you can see we start with a 24.6% growth rate, then 16.9, and then we plateau at about 6.5 when I estimate that the Disney Plus viewership or subscriber growth should slow down considerably. And with this, I get a price estimate of $224.30 or 51.91% upside. For my relative valuation, I wanted to place significantly higher weight on the DCF valuation because I felt that none of the comps were good pure plays because they were all either theme parks or content creators and distributors, but not both like Disney was. I felt that Disney had a much more robust business model than the comps, which justified it trading at a significantly higher EV to EBITDA multiple, but I felt that there was no comp that could directly capture just how lucrative Disney's business model is. So for that reason, I placed a weighting of 80% on the DCF estimate and 20% on the relative value price estimate, and this yields a price target of $206.13 or 39.6%. Of course, there are risks to consider, and the ones I've identified are changes in consumer preferences, new market entrants, oversaturation of the streaming space, slowdown of consumer spending, and adverse economic conditions. Now that I've told you what to buy, I'd like to take a contrary position and tell you why I believe Netflix should be sold. As of late, their subscriber growth has suffered. They've fallen short of their estimates for the past 2 quarters, and it looks like there's no trend of improvement here. Subscribers have been cited as leaving due to higher prices by Netflix and more competitive pricing by competitors that are entering the streaming landscape. On top of that, Netflix has a serious cash burning problem. They have yet to achieve a positive free cash flow, and their deficit is increasing year on year. Uh, New players will be entering the video streaming space and will take away market share and further slow their subscriber growth, which will not help out shareholders. On top of that, new players will take the non-exclusive content, will take their exclusive content off Netflix for their own platforms. Think, as we've seen with Friends and HBO Max, and this will lead Netflix to have to burn even more cash in the future to develop their own proprietary content. And we can see this, that it's not just me who's giving this position, but short interest has been rising exponentially over the past year as it relates to Netflix, now sitting around the 25 millions figure. Thank you very much.